Today, we will talk about risk and rewards of investing. Investing is a financial strategy that involves allocating resources, typically money, with the expectation of generating a positive return over time. It is a critical aspect of wealth building and financial planning. However, investing is not without its challenges, and understanding the risks and rewards associated with it is essential for making informed decisions. What is investment risk? An understanding of investment risk is crucial to maintaining an appropriate long-term investment strategy. Risk can, and should, be interpreted in many ways. To some people, risk means the likelihood of achieving a return below their expectations. For others, it could be the chance of losing money, failing to keep pace with the cost of living, or failing to meet a specific target. What all of these have in common, however, is that they relate to uncertainty. Investing always involves a degree of risk. It's generally understood that the higher the risk you take, the higher the potential reward, but also the potential for loss. What's often difficult is determining where you should sit along the scale of potential risk and reward, and then determining how you should design your portfolio accordingly. Risks of investing. Market risk. Market risk is multifaceted, influenced by macroeconomic factors, geopolitical events, and market sentiment. Economic indicators, interest rates, and global crises can contribute to volatility. The interconnectedness of global markets means that a disturbance in one part of the world can have ripple effects elsewhere. Mitigating market risk involves not only diversifying across different industries and regions, but also staying informed about geopolitical developments and macroeconomic trends. Interest rate risk. Interest rate risk affects fixed income securities, such as bonds. When interest rates rise, the value of existing bonds tends to decline as newer bonds offer higher yields. Investors can employ strategies like laddering, diversifying bond maturities, to manage interest rate risk. Additionally, understanding central bank policies and economic forecasts can help investors anticipate interest rate movements and adjust their portfolios accordingly. Inflation risk. Inflation risk is an ongoing concern for investors as it erodes the purchasing power of money over time. While certain investments, like stocks and real estate, historically provide a hedge against inflation, investors need to carefully consider the long-term impact of rising prices on their portfolios. TIPS, Treasury inflation-protected securities, and other inflation-indexed instruments can be valuable additions to a diversified portfolio. Liquidity risk. Liquidity risk becomes apparent when investors face challenges in buying or selling assets without causing significant price fluctuations. Less liquid assets, such as certain stocks, real estate, or private equity, may become particularly problematic during times of market stress. Investors need to strike a balance between potentially higher returns from less liquid investments and the ability to quickly convert assets into cash when needed. Credit risk. Credit risk is inherent in debt investments, where the issuer may fail to meet interest payments or return the principal. Assessing credit risk involves analyzing the financial health of bond issuers, understanding debt covenants, and staying informed about industry and economic conditions. Diversification across issuers and credit ratings can help mitigate the impact of a default on individual investments. Rewards of investing. Capital appreciation. Capital appreciation is the engine driving long-term wealth creation. Investing in assets with the potential for sustained growth, such as equities, allows investors to benefit from compounding returns. Patient investors who stay committed to their investment strategy can accumulate significant wealth over time, taking advantage of market upswings and weathering downturns. Dividend income. Dividend-paying stocks offer a source of regular income, making them attractive for investors seeking cash flow. Companies with a history of consistent dividend payments and a commitment to dividend growth can provide a steady stream of income, allowing investors to benefit from both price appreciation and income generation. Portfolio diversification. Diversification goes beyond merely holding different assets. It involves a thoughtful allocation across various asset classes, industries, and geographic regions. The goal is to construct a portfolio where the performance of one asset offsets the underperformance of another during different market conditions. Regularly reassessing and rebalancing the portfolio ensures that it remains aligned with the investor's risk tolerance and financial objectives. Tax benefits. Understanding the tax implications of different investments is crucial for optimizing after-tax returns. Tax-efficient investing involves utilizing accounts with favorable tax treatments, such as retirement accounts, and considering tax loss harvesting strategies. Investors can also explore investments with preferential tax treatment, such as qualified dividends and long-term capital gains, to enhance their overall tax efficiency. Financial goals achievement. Investing is a means to an end, achieving financial goals. Whether the objective is saving for a child's education, purchasing a home, or building a retirement nest egg, a well-crafted investment strategy is essential. Aligning investments with specific financial goals involves considering the time horizon, risk tolerance, and liquidity needs associated with each goal. Regularly reviewing and adjusting the investment plan ensures that it remains on track to meet evolving financial objectives. Investing is a dynamic and evolving journey that requires a nuanced understanding of the risks and rewards involved. Successful investors not only navigate the complexities of the financial markets, but also adapt to changing economic conditions and geopolitical landscapes. Continuous education, diligent research, and a disciplined approach to risk management are key components of a successful investment strategy that stands the test of time. By acknowledging the intricacies of risk and reward, investors can make informed decisions that contribute to long-term financial success. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.